Welcome everybody back to Team 120's Financial Education for Middle America. My name is David Tristan with Family First Insurance and Financial Services.
I'm Louis Martorelli, Martorelli Financial Services.
We are Team 120 Financial Services San Antonio. So Lou, why don't you tell us what we did last week?
Right, so as you remember last week, we broke down the different options that people have when it comes to retirement investing. It fell into three different categories.
Yes, the three buckets.
Right, the three buckets, and those are the three tax buckets. And the final tax bucket is the one that's probably the most attractive, and that's the tax-free bucket.
Oh, I love tax-free money.
Yeah.
No money to Uncle Sam? Yes.
Right.
So what are we going to talk about today?
Right, so the primary component, the primary investment vehicle in the tax-free bucket is life insurance.
Okay.
Life insurance is something that most people don't really think about when it comes to retirement investment. And we're going to dig down deep into that. But before we do, we really need to clarify the different types of insurance. And that's what we're going to talk about today in this episode.
Okay, great. So let's start with term.
Right.
So most people out there will clarify term insurance, and they may have some understanding, but let's just break it down to what it is.
Okay.
All right, so term insurance is really pure insurance. It is exactly what it says. It is a temporary insurance for people. Okay, if I go out and I buy a term insurance policy, when I die, my beneficiary gets the sum of that money.
Right. So what you're buying when you buy a term life insurance is a death benefit.
That is correct, and that's strictly it. That is the basis of what a term policy is.
The only time it's going to pay out in most instances is when the insured dies.
That's correct. So it'll go to your beneficiary. That's how most people understand what life insurance is.
Right.
Okay.
So why did they call it term?
So they call it term because you're going to pay into it for so many years. Usually 15, 20, 30 years.
So it's temporary.
It's temporary. That's correct. So for these 15, 20, 30 years, you're paying into a premium, and once one of these years comes up,
When the term expires,
you're done.
The coverage expires.
That's correct. So I no longer have term insurance. I'm 15, 20, 30 years older, and now I have no life insurance.
So this is the type of coverage that most employers offer, right? So if you have insurance coverage at work, this is what the type of insurance that you have.
That's correct, but it's not a 15, 20, or 30-year term. It's a year-to-year basis. So as long as you're there, you have coverage.
And it's not a lot. Usually maybe one and a half, up to 3 times your salary.
That's correct. And you can't take it with you when you leave.
Right. Okay. So what a lot of people say that the primary thing with term insurance is that it's cheap.
So let's clarify that real quick. Okay? So if I'm a 30-year-old man, let's just say I am, and I bought a $250,000 policy, my current rate right now would be about $70, give or take. I mean, there's some other insurance companies that'll give you, but let's just say it's $70.
So the premium, $70 a month, that sounds low.
It's pretty low for $250,000.
Right.
But let's say I live all 30 years.
Right.
At the end of those 30 years, I would have spent over $25,000. And now what?
Right. So now the policy expires, you no longer have the coverage.
And I'm out $25,000.
Right. And you're 30 years older. So,
And now insurance is going to cost me more.
right.
So I think we're done with term here.
Okay. It has its advantages, but let's not leave out permanent insurance. And as you can tell by the name, it's going to have different characteristics than term insurance does. The two primary characteristics of permanent insurance is that you have the coverage for as long as you pay the premium, okay, and it has a cash value component, unlike term insurance.
Okay, so this has a pure insurance and a cash value.
That's right.
Okay.
And the coverage for the death benefit lasts with you for as long as you pay the
So if I'm 80 years old and if I started off 20 years ago, whatever I paid 20 years ago, I'm going to pay the same at 80 years old.
That's right.
Great.
And you have to continue to pay that premium if you want the death benefit.
Okay.
And what happens is a portion of your premium every month goes towards the cost of insurance, and a portion of your premium goes into a cash value bucket.
So I'm paying money monthly, and I have a cost of insurance and a cash value.
That's correct.
Okay.
There are many different types of permanent insurance. For our purposes here today, we're going to talk about three primary types. And the first one is whole life insurance.
Whole life. Tell me about whole life. Well, that's like what my mom and my grandparents have, right? Whole life?
This is what most people are familiar with when you talk about permanent insurance.
Okay.
The way that, as you can tell by the name, whole life insurance covers you for your whole life. It's always going to pay out something, whether it pays the death benefit to your beneficiary, or if the policy matures, it's going to pay the death benefit to you, or if you surrender the policy, you're going to get money. You're going to get money back.
Okay.
The way that the cash value is treated in a whole life policy is it's a fixed interest amount, and that's the way that the cash value grows.
So I make a little bit of money, right?
You make a little bit of money in a whole life policy.
Okay.
The second type of permanent insurance is a variable life insurance. The primary difference in a variable life insurance policy is that cash value component, okay, is invested in the stock market.
Okay, so my cash value has chance for growth and risk.
That's right. So there is the possibility that it would grow faster or more than it does in a whole life policy, but you're just like your normal stock market investments.
Okay.
It's exposed to risk.
Okay.
And then finally, you have your universal life policies.
Universal life. What's this?
Right. So the primary characteristic of a universal life policy, what differentiates it from variable and whole, is that your death benefit and your premiums are flexible.
Oh, wait a minute. So my death benefit and my premiums are flexible. How is that beneficial?
Well, because as we move through each stage of life, our needs change, and what we needed early on when we bought the policy may be different later on.
Well, you're right. I wasn't born with a wife and kids.
That's right, and so later on, death benefit may be less important to you than it is when you first bought the policy and you had dependent children. Also, you may not be able to pay the premium because your income doesn't change.
You usually make less in retirement.
That's right.
Okay.
There are two primary types of universal life insurance.
What's the first one?
Fixed universal life insurance.
Okay.
And indexed universal life insurance.
So fixed is kind of self-explanatory. It's almost like a whole life. Set interest rate, that's where it grows.
That's right.
And indexed?
In an indexed universal life insurance policy, that cash value is credited based on the stock market index, usually the S&P 500.
Okay.
Okay.
So is it in the market?
It's not in the market. So unlike a variable life insurance policy, your cash value is not exposed to risk. It has the potential to grow more than a fixed policy or a whole life policy, but that money is not exposed to risk. You cannot lose the money in your cash value.
Wow, that's exciting. Okay.
So that's the type of policy that we're going to dig down deeper into later on in this series when we start talking about how to use life insurance to provide income in retirement.
Okay, so next series we should be digging into more of these different types of permanent.
Yeah, now I hope we clarified insurance for you a bit more, and that you understand better the different types of insurance. If you have any questions, we're here to assist you.
Absolutely.
Don't hesitate to contact us. How can they contact us?
You can email us at team120, and that's all spelled out, team120@outlook.com.
Like our Facebook page. You'll find our contact numbers at our Facebook page. If you want to give us a call, don't hesitate.
Yes, you can message us there also, and also like our YouTube channel at Team120, also all the way spelled out.
Thank you for watching our video, and we hope that you come back for later episodes.
Absolutely, and once again, if there's anything we can do for you, Team120 is here to help you find your solutions. Thank you.